where they put depreciation, so basically.
In my experience, it's sometimes they are, sometimes they aren't. Generally, what I will do is I will go back to the cash flow statement. That's been the easiest place for me. Although on the cash flow statement, it's showing you how much the depreciation is, but not necessarily where it's put.
I can't really read a lot of these, but under the proposal, are they going to try to incorporate the off-balance sheet leases into this as well?
Right. So that if you click on the image, it'll pull out the image, and it'll be easier to read. Okay. And I apologize for that. It was difficult to get it all in one slide because there are so many line items there. But yes, I mean the question that you raised was one that dealt heavily in the Enron situation, right? In which they had a lot of off-balance sheet financings. And so yes, I do think that they're going to make more of a concerted effort to have this stuff reflected. Although there are general rules about consolidating versus non-consolidating events having to do with the ownership. I think the threshold is 50%. The problem is when you have companies constantly owning 49% of things because they don't want to reflect them. Okay. But a couple of statements here. First of all, is just the name, right? We've gone from income statement, the statement of balance sheet. I'm sorry, from balance sheet to statement of financial position. Clearly, statement of financial position is a better name, right? Because you're looking at the financial position of the company. Balance sheet is kind of a jargon that's arisen over time, right? But statement of financial position is what we're at, just like statement of cash flows, statement of financial position. I think that's a better name, but it's kind of like trying to go from the English system to the metric system, right? Makes sense. People are used to the term balance sheet. So the other thing that you'll notice is many more line items. Okay? Good for accountants, a lot more work there. Maybe not so good for the companies that have to pay those accountants. For the investors, clearly a good thing. Also questions of whether or not they're going to use it, right? If you take a look at how the information is arranged, you've got operating. Remember, that was the number one that we wanted to pull out, was operating assets and liabilities. You've got financing. And you don't really have investing, but on the statement of financial position, you've got the income and the equity broken out. Okay?
When will this be? When will this come about?
It's not clear. FASB is known for being a very slow organization. Okay, so I think when you're dealing with FASB, you're dealing with years, maybe decades. Remember with FASB, they had considered in the 1980s incorporating the stock options, and they basically got talked down by Sand Hill Road, right? Because they didn't want to expend stock options. Congress got involved, and now I think that's going to happen. There's a lot of consensus building here, right? People want to make clear that this is something that the industry wants to do because it's really very hard, right, to force people to change. Again, you don't want to run into a situation like Sarbanes-Oxley, where you do something that appears, right, to be the right way of doing it. You always have the option of being private, right? In which case, you're not going to help anybody. So again, if you click on the picture, I think it's a little bit easier to see. Here you can see the statement of comprehensive income, all right? And you can see that we've gone from just a few line items here to a huge number of line items here, all right? So we have a better name, statement of comprehensive income, I think is a better name than the income statement. And what we also have is, again, the grouping, all right? So we've got operating or business. Down here you've got investing, and down here you've got financing. Okay? You have more line items, and you're splitting out the three basic components of business. Your operating business, how you're investing in that business, and how you're financing that business. And a lot of this stuff also you'll see even within each category. So you've got net sales, cost of goods sold, selling, general administrative. So they try to break out the expense by each particular area. Okay? So for example, pension costs. Pension costs are broken out between selling and between general administrative. All right? Which makes a fair amount of sense. And actually, a lot of these numbers, they're not that hard to come by. Okay? And, as we'll discuss at another time, given more and more quantitative analysis, it's actually really not that hard to make use of this information either. just get computers, right? Computers will fly through this information, right, and make good use of it. All right? Any question on the statement of comprehensive income?
Where is the net income line?
The net income? Isn't that the last line? I thought this was it right down here, no?
Continuation.
What's that? Oh, it's all, no, this is current,
Oh,
and this is
sorry.
proposed.
Comprehensive income.
Total comprehensive income.
Oh.
Okay.
All the way to the bottom. And this one, you'll notice, is not as different. So this one here is the statement of cash flow. Name hasn't changed, right? Accountants have always preferred cash flow statements over accrual-based accounting. And what you'll see here is just a few minor changes under the operating cash flow. And I'll leave you to look through these. Tell me if you have any questions. All right. So let's go through the major line items that we have now. We put this up here in a little bit bigger font so it's easier to see. We have on the balance sheet, or the statement of current financial condition, we have the two major categories are assets and liabilities. Okay? Let's start off with assets, and of course, assets minus liabilities is your shareholders' equity or book value. Okay? The first big delineation that you'll see is current versus non-current assets, also called current versus fixed assets. Non-current is probably a better term. Anyone help me out with the difference? What's the difference between current and non-current? 12 months. Okay. In here we see cash and cash equivalents. Anyone help me out with the difference between those two? No. Cash equivalents are not short-term investments. Generally, it's also maturity, 3 months, right? So if it's freely tradable stuff, right, that you can instantaneously convert into cash, those are cash equivalents, right? So if you owned, and I'll warn you that accounting is not my strongest suit, so I'm a little nervous about having this on being recorded, but if you have something like Amgen shares, which you can just click a button and convert into cash like that, that to me would be a cash equivalent, okay? A short-term investment would be something like a 90-day T-bill, okay? Something that should be able to be cash in a relatively short period of time, certainly less than 1 year, okay? Money market funds, I would assume those would also be cash equivalent, but again, if they're 90-day CDs, those would probably also be short-term investments. It's been my understanding that's a 3-month cutoff, okay? Accounts receivable, everyone comfortable with accounts receivable? What are accounts receivable?
Put it sold, but you haven't received.
It's the amount of money that you receive, okay? What do you do with the bad debt allowance, accounts receivable?
We don't cheap.
How do you account for bad debt in accounts receivable?
Percentage based on probability to get paid.
Generally, it's based upon past experience. Right. So if you can take a look, now you can take a look at what your bad debt was for 2006, right? And you kind of assume that it's going to be that way going forward, okay? Inventories, prepaid expenses. What are prepaid expenses?
Insurance.
Expenses that you paid for but haven't received the service for.
Right. So you've got a warehouse full of widgets, okay? You've already paid for those widgets. They're sitting in there, right? And they have a value, right? Because you had to make them. How do you account for the value of the widgets in the warehouse? What are the value of those widgets? Widgets are sitting in the warehouse, right? And let's say, right. What's the difference between LIFO and FIFO? What do those acronyms stand for? Last in, first out, first in, first out. So let's say that we were making widgets earlier this year at $1 a widget. And now, because of inflation, it's cost